everyone, and welcome all to Capital Link's Deep Dive webinar series. My name is Jostein Aschjem, and I'm an shipping equity research analyst at the DNB Carnegie. At DNB Carnegie shipping team, we currently cover 28 companies, among them Navigator Holdings, where we have a buy recommendation and an $18 target price. Today, I'm joined by Mr. Peter Zacho, the CEO of Navigator Holdings, for an in-depth discussion. And I've prepared an extensive list of questions for Mats covering Navigator second quarter highlights, the outlook for the third quarter, recent development, and the longer-term market outlook, and the outlook for Navigator Gas. Navigator Gas is listed on the New York Stock Exchange under the ticker symbol NVGS and is a global leader in the seaborne transportation of petrochemical gases. Additionally, it owns a 50% share through a joint venture in an ethylene export terminal at Morgan's Point on the Houston Ship Channel in the US. Before we start, just a short disclaimer. And please note that the discussion is strictly for informational and educational purposes only. It should not be considered an offer to buy or sell securities or investment advice of any kind. The full disclaimer is detailed in the opening slides. So let's begin. I shortly touched on it in the introduction, Mats. Well, I'm sure you can do it a lot better. So to kick it off, could you tell us a bit about Navigator Gas and what makes it unique?
Yes, thanks a lot, Jostein. Look forward to the discussion. And I think you've already pointed to a couple of my points. Navigator is a leader in the handy-sized gas tanker segment, and I think it's quite unique. You don't see that very often in shipping, that a single company holds over a third of the global market in its segment, and we do in the handy-sized gas tanker segment. We do transport a wide range of gases, primarily LPG, ammonia, and petchems. So this variety when it comes to cargo types, I think is also, you could say, somewhat unique, particularly in the gas tanker segment. We do own both vessels and land infrastructure, which is a specialty of ours. There are some very significant commercial synergies between part owning a terminal and the shipping fleet that actually serves that terminal. And that provides also stable cash flow, which I think we showed in Q1, where we had good complementary performance in our infrastructure and our shipping business. And then, of course, we have a very competent and super engaged team on shore and on land.
Yeah, sounds very good. But it also sounds a bit, to me at least, sounds a bit more complex business for investor to follow, with, as you mentioned, multiple products being transported in addition to also the terminal asset. What do you think is like the main advantage of investing in Navigator Gas compared to a pure play sort of VLGC owner or other pure play shipping companies?
I think it's primarily two things. I think one is the stability of the cash flows, and you've seen that over time that we have gradually grown, but with quite good stability compared to most other shipping segments. And that really has to do with this diversification in terms of us having vessels both in the semi-ref, in the ethylene market, in fully refs at the same time, and also the combined effect of having terminal income, which by nature is also relatively stable. I think we have the luxury of being a market leader in a growth market, and I think that's really a feature of the position that we have. And you can contrast that with having a company that has only one exposure, one commodity. Here you will have more volatility, and there'll be more asset play in some of the other segments within gas tankers, and there'll be many investors that find that attractive and can invest in and out of that market. You don't get that same kind of volatility either in our asset prices or in our revenue streams. But I think having a fleet that can transport multiple types of cargo, that can never be a disadvantage for our industry and for our trading. I think that the fortress market position that we have, it gives resilience, it gives stable cash flows, and I think it also lowers our cost of capital.
Yeah, sounds interesting. I mean, we will come a bit more back to the diversification in terms of product being shipped and also the infrastructure asset. But on the note of stable earnings, I think it's very interesting to look into what happened during your Q2, You reported the results a couple of weeks ago, and it was a quarter, of course, heavily impacted by geopolitical situation with the US-China tariffs, which disrupted one of your core trade lanes. In addition to the imposed restrictions on US ethane export to China by the Bureau of Industry and Security. So looking into the shipping segment maybe first, so your time charter equivalent earnings per day declined 7% versus Q1, and with the utilization across your fleets coming down to 84% versus 92% in Q1. Could you just shortly recap for us what really happened during Q2 and how did this geopolitical events impacted particularly your shipping segment first?
Yeah, I think there were really three big events that happened after Liberation Day on the 2nd of April. First was all the discussion around port fees, where the implementation of port fees on initially vessels that had pretty much anything to do with China created a lot of uncertainty. They were later changed, so they only affect vessels that are importing into the US and also those that are Chinese operated and owned. So now we are off the hook when it comes to the port fees, but it was really just an uncertainty that made many of our customers stop and hold off on transportation. I think then came the tariff war between the US and China, where at some point in time the tariffs were voted all the way up to 135%. And that, of course, would effectively stop any trade between the US and China. That went away also, and now the tariff on US cargoes going to China is very small indeed. But again, it created for a short period of time a lot of uncertainty. Customers stepped back and waited for clarity on this regulation. And then came the third and last one was around the export licensing on US ethane exported to China. And that basically stopped all shipment of ethylene or ethane for about a month or so. So the combined effect of these were that our customers stopped. They waited just to get clarification before they chartered vessels in, and that meant that we saw our utilization reduce. Our volumes went down during that 3-month period. So it's mainly that general uncertainty because it then also in the slightly longer term reduces investment in new products and so on, projects and so on. But it's harder to measure, but it could even be more serious. So that was a big impact in Q2. The good thing is that it seems to be behind us now.
Yeah, so I think it's very interesting also to see how the dynamics of being a diversified player during times like that impacted the results as well, and also maybe the product mix you carried on your vessel. How did like the LPG share, the ammonia share, and the petrochemical share developed in Q2 with all these disruptions compared to Q1?
Yeah, I mean, we saw our utilization on the ethylene fleet go down to 75%, which is low. Typically, it sits in the low 90s, so it's a big reduction in that. When we then looked at our semi-ref fleet, which is where we have the most of our ships, it actually went up above at some point in time above 90%, even when these uncertainties were playing out. So we had a pretty good response, you could say, in our semi-ref fleet. There was a lot of LPG exported out of the Persian Gulf to India, to South Asia. So there were other opportunities where we could fully utilize that part of our fleet. So yeah, this was certainly a situation where had we had only one exposure, that is to the ethane fleet, then we would have had a much harder hit to our cash flow generation. So it was good to see the resilience in our business model.
Yeah, very good to have multiple legs to stand on.
Yeah.
And in terms of the development since you reported the Q2 results, how have the sort of the trade flows on LPG, ethane, and ethylene as well been developing since then? And in terms of fleet utilization for your shipping fleet and also the rate levels into Q3, how do you expect them to develop?
Yeah, the good thing is that we've seen the natural gas liquids production in the US. And natural gas liquids, that's really the propane, the ethane, the butane, broadly called natural gas liquids. We've seen the production here in the US. It's back up at record levels, and keep in mind about 42% of the gas that comes out, that's ethane. 28% is propane when it comes to the natural gas liquid. So ethane is a big and important commodity when in US gas production. So we've seen the production back up, and the exports are following, also because we see the infrastructure built out. And here I can mention the Enterprise Neches River or Beaumont terminal opening in July with the first export flows going from that, which was good to see. And that meant all in all that our utilization went back up to just over 90% in July. And right now it's still robust. We haven't seen any surprises, so it looks good for Q3 and onwards. We see the average rates are back up above 30,000, which is not dissimilar to what we saw in Q1. So we have better utilization, of course, of our terminal right now compared to Q1. So all in all, it's a good normalization and back to strong performance.
And are you still seeing any sort of disruptions on the trade flows from the US-China tariffs?
No, we don't see that anymore. I think that pretty much evaporated in the early part of July.
Yeah, so all sort of trade patterns being the same now.
Yeah, exactly. I mean, you can still discuss whether there are some uncertainties. I mean, I don't know about you, but every morning I wake up and I take my mobile phone and see, oh, what's news? We've
Yeah.
gotten used to a quite volatile geopolitical environment, and that, of course, is something that makes everybody a little bit more cautious. We haven't quite been able to measure the effect of that, but that's a concern to me.
Yeah. I think we will come a bit more back to the NGL production in the US as well later in this discussion. But I was also thinking that we maybe could go through your recent development in terms of the fleet. So you announced a couple of months ago, I think it was, an order for two MGC ammonia vessels through its newly established Navigator Amon shipping. I just wanted to ask, how did this JV really come around, and why was it done jointly rather than only for Navigator's account?
Yeah, no, we've known Amon, our joint venture partner, quite well over the past couple of years. We invested into Azane Fuel Solutions, a company that was established by Amon. We invested together with Yara into the company, a company that provides infrastructure solutions, bunkering solutions for ammonia bunkering for the shipping business. So we've been working together. We sit on the board and have a good relationship there. They secured the Enova grant, the grant from the Norwegian authorities, giving $9 million of grant to the building of each of those two vessels. So it's quite natural that they brought to the table a very important value driver here. And given that we had this good working relationship over the past couple of years, I mean, it was very easy for us to make the decision of partnering up with Amon on this one. We have a number of successful joint ventures already, both with Morgan's Point, with our 5 ethylene handies, with Greater Bay and other joint ventures too. So this is a good way of working for us, and here we of course provide operational capacity to operate those ships and also participate in ensuring that they are built on time, on budget.
Yeah, very good to partner up with good partners, and also very beneficial to get the $9 million per vessel in support building the
Absolutely.
vessels.
Yeah, and I mean, that means that we can build those ammonia carriers with, you could say, the grant covering the ammonia propulsion and all the additional energy efficiency features and so on. So we get a very highly spec'd, super flexible vessel at a price, you could say, that you would pay for a very traditional, old-fashioned technology vessel.
Yeah, and you also have a time charter contract connected to each of those vessels as well,
Yes,
which is
yes,
helping in de-risking the investments a bit.
absolutely.
So that's very positive. You have also done some other business in order to optimize your fleet. So you ordered four mid-size ethylene capable vessels. You recently also purchased 3 handy-size ethylene capable gas carriers. and sold one older handysize ethylene capable vessel early in 2025. How do you sort of see the size of the vessels you're most focusing on at the moment? Do you expect Navigator to move sort of more into the mid-size segment?
Yeah, I think that's probably a natural conclusion, given the only orders we have right now are in the mid-size segment. There's a natural size creep in our industry overall. It comes with infrastructure development that allows bigger ships, and because of the economies of scale are quite important here. It's a very, when you measure it as dollar per ton of cargo transported, I mean, if you build a ship that's twice the size, and the ship is actually not very much more expensive than the smaller one, then you see a natural economies of scale in doing that. We really like niches like ethylene, like ammonia propulsion, so that we can be a large fish in a small pond. So we are not mindlessly just plowing into the MGC market. I think there's already a pretty substantial order book here, but where we can see that we can go in at low risk or into a niche where we have a large existing presence, I think it's not so difficult a decision for us. I mean, over time, you'd probably see more ethylene capable vessels and ammonia vessels from our side. Nothing imminent, but over time, those are really the positions that we want to build.
Yeah, so moving a bit away from the LPG trades, maybe, and more into ammonia and ethylene going forward.
Yeah, because if you see the LPG transportation that goes across the large basins in terms of the Pacific and the Atlantic Sea, there you have the VLGCs doing that transportation. So we, on a cost per ton, we can't compete with that. We will do the regional distribution, as I mentioned, out of the Persian Gulf to India and so on. But there will be size creep in that segment too. So LPG will gradually be a smaller product for us, and that's fine because the other niches are very attractive too.
Yeah, and also supporting the export levels out of your terminal as well.
Absolutely.
So if we're moving a bit away from the shipping part of your business and over to the terminal part of your business, so you recently expanded the Morgan's Point terminal by 55% in late 2024. But if we look at the throughput level from your terminal, the utilization level has been subdued in the first half of 2025, with 22% utilization in Q1 and 69% utilization in the second quarter. What do you see as the main reasons for the reduced utilization in the first half of 2025?
Yeah, I think the key explanation is from Q1, where we saw a number of cracker turnarounds in the US. You saw, and that meant that the production went down, and that meant that the domestic pricing of ethylene in the US was very high. And effectively, that means that the arbitrage is closing. There's not room for transportation of US-based ethylene to either neither Europe nor Asia. So that meant that very little product moved when it came to ethylene at that point in time. Since then, we've seen improvements month by month. We've seen the US domestic prices coming back down as the crackers came back up on stream. And that means that we are now operating at much better utilization levels. We're still below capacity, as you mentioned. I think before we get back to the 90+% that we were, you could say a year ago and previously, we need to have some more offtake contracts in place. And we are working actively on that. We have a number of term sheets out together with enterprise to customers. And it's difficult for me to forecast exactly when the timing comes, when the offtake is getting into place. But that's what we're working towards. I think we expect Q3 to be better. We see some European rationalization here, where ethylene starts flowing to Europe because naphtha-based ethylene production in Europe is being closed down. So we hope that we can get back to 50% plus in the mid to longer term, like we had the last 5 years.
Yeah. So do you have any sort of long-term goal for the utilization of the asset? Is it like 90% plus? You're
Yeah, I
happy
think
with
it's
that?
fine. I think it's fine that we have a little bit of space for spot cargoes. But given the expansion that we did in the beginning of this year, where we had this flex feature where the terminal can switch between ethylene and ethane, and that enterprise has moved some of its ethane exports up to Neches River, that means that we have now more free capacity from time to time when it's not used by enterprise for ethane. And that's great. That means that we ought to try and bring in place offtake up to more than 90%, so we have that stability in the product flow.
Yeah, and you also mentioned these offtakes agreements, and if you compare sort of the margin level on a dollar per ton basis compared to the contracts you signed maybe in 21, 22, or 20, um, how is the development? Do you see like a higher fee per ton now compared to back then?
It depends a lot on the structure of the offtake agreements, because if you have an agreement that runs for multiple years, it tends to be priced more competitively, lower priced. If it's a large volume offtake, of course, it also means lower prices. So it depends on size and duration and so on of those. So it's a little bit difficult for me yet to forecast exactly how we're going to end up on the new offtake, whether it's going to be higher, lower, or same. Yeah.
Mm, yeah. So positive developments across the space, both for terminals and also for the shipping part of your business. If you
Clearly a
just
step forward from Q2 to Q3.
Yeah.
That's an easy answer.
Yeah, perfect. So if you just take a step back and look at your business, maybe 10 years ahead in time, how do you see the development for contributions stemming from more infrastructure assets, sort of the like the terminal compared to the shipping part of the business? Do you have any sort of goal between those two segments?
Yeah, we don't have any fixed targets. I mean, the world is a volatile and interesting
Indeed.
place to be, and 10 years is a long time. But there are some significant synergies from having both a transportation business, a shipping business, and an onshore infrastructure business. That's for sure. We have clear evidence of that. It takes time to build infrastructure. It takes more time, and we also plan to grow our shipping activities as well. So it's a little bit difficult to say where we're going to end up. Doing onshore infrastructure also requires some partnerships. We have great partnerships with enterprise in the US, and we would rely on having partnerships also for doing more infrastructure, that being on US ground or in Europe or elsewhere. So it'll all take a bit of time to put in place. If I was to dream a little bit, then maybe all the way up to 25% in 10 years, I think that would be a magical split between our transportation and the infrastructure part.
Yeah, you have a couple of interesting projects as well, and
Yes.
potentially to materialize in the coming years, like the 1008 ammonia project. Do you think your investment into infrastructure stops with terminals, or can you go further down on land with pipes and upstream part of the value chain as well?
No, I wouldn't see that happening. I think it has to have that close shipping link. So I think it has to touch the water somehow. Otherwise, I think we would be moving out of where our capabilities can stretch to.
Yeah, I understand. If you go a bit back to the shipping markets, maybe. So it seems as you mentioned that the rates are back to solid levels. It's a bit harder to follow like the daily movements and weekly
Mm.
movements in the spot markets for your vessels compared to other vessel classes within the in NGL shipping segments like the VLGCs. I just wanted to ask like how interconnected are your vessels with the market dynamics for the larger vessels like VLGCs and VLECs? Do you
Yeah,
see any sort of benefits from the current strength in the VLGC freight markets?
I think let's split it up into and look separately at the VLEC and the VLGC market. When it comes to VLGCs, which is you see the likes of Dorian and BW LPG and so on. They are strong and good players, you could say, in that field. And there is some effect, you could say, from the strong rates that they are achieving right now. But it typically comes in a in a smaller effect onto our ships. It goes through the mid sizes. They are doing much better now than they've done for a while, and have strong bookings right now. So we can see that it's working its way down through the segments, but it's pretty muted. If we look at the historical rates, you'll find that there is some correlation over the past 5-6 years. All rates, you could say VLGCs, MGCs, and our handies has generally moved up, and you'll see the peaks and troughs typically come around the same time, but it's just much less pronounced when it comes to the handy size. I think when it comes to the VLECs, it's different because they are typically built for a specific project. They are fully contracted, so we don't see any read across. Really, there's not a spot market for VLECs. There's only a spot market for our handies, and so there's a full separation there.
Yeah, so it's more sort of a spot market, more like the LNG space with long-term time charter contracts for offtake volumes rather than more spot shipping for VLGCs.
Yeah, and exactly. So you very rarely see a VLEC take a spot cargo. Those typically go on the likes of our ships.
And do you think it will continue going forward as well with a lot of
No, I think
VLECs being delivered? Yeah.
No, I think over time it will change. I think we'll see the size creep also in this respect. I think over time we'll see a spot market develop, but for the MGCs first. And I think that's going to run for a long period of time because there are quite few terminals that can take the VLECs. So if there is a spot market to develop in this, it will start where it is right now with the handies. It'll gradually move to MGCs and potentially could go on like the ships that we have on order right now, the 4 mid-sizes that are ethylene ethane capable, and then over time, who knows? One day maybe a VLEC will be doing some spot trading. Who knows?
Yeah, exactly.
It'll take some time.
Yeah. We talked a bit about very briefly the importance of the NGL production in the US. And I think if I remember correctly, it's like 50-60% of your earnings days are stemming from the North America.
Yeah.
So exports out of the US is obviously a very important factor for your fleet as well as the freight market supply and demand balance. We've seen during this year that oil prices has come down somewhat, and also with a forward curve in backwardation, partly impacted by the announcement by the OPEC of unwinding cuts and supplying more oil into the market. This has also pressured the US rig count somewhat, which eventually could lead to lower US NGL production and therefore also export for both ethane and LPG in the coming years. And if you compare that to the supply side, so if you take just all LPG ethane vessels, the fleet capacity is set to increase by 10% next year, 20% in 27, and with a total order book of 40%. So if you just make a scenario where US oil production is flat from 25 into 26 and 27, how do you think this will impact your fleet? And do you think the export growth in LPG and ethane will be sufficient enough to absorb the extensive fleet growth in the coming years?
Yeah. I think we'll see continued production growth when it comes to gas. I mean, oil production can be flat while the amount of NGLs coming out is growing. We've seen that in 1921. We see it now in 24, 25 as well. And much of it has to do with the gas to oil ratio of the total production in the Permian Basin that it's raising. I mean, there's more gas produced compared to oil. And there are, of course, also some gas fields that are not oil related here. But if the pricing is right, then the producers will switch to producing more wet gases. And the wet gases are the ones that contain the natural gas liquids that we transport. So I think we will see export capacity growth when it comes to ethane. We will see that less of the ethane that's produced is being rejected into natural gas. That's what you see. If you can't get rid of the ethane by export because there's no infrastructure, then what you do is you spike it back into the natural gas and provide, you could say, high octane natural gas instead. But that's what we're seeing now, is that the export infrastructure is being built out. I mentioned just before the Neches River Beaumont terminal by Enterprise, and that's just one example of more export capacity being available. So we'll see much more ethane that is taken out for export, and we'll see more gas produced in general.
Yeah, it's definitely sorry. Go
No,
on.
no. It just, I mean, if you look at Enterprise and see the infrastructure build out that they are planning and they are executing on, it's well timed together with the fleet growth that we'll be seeing. So most of the VLECs are ordered against concrete contracts, and that means that I'm less worried about the overhang here. So all in all, it's always difficult to figure out the timing, whether the export infrastructure is coming out exactly the same time as the vessels are being delivered. But I think there's a good people have been thinking hard about this, and I think the balance could be okay.
Yeah, but it's also a very changing geopolitical situation this year, impacting the future NGL production, oil production as well. It's definitely a massive build out in terms of export capacity, pipelines, and also fractionators. But do you think like NGL will be sufficient to fill up those export terminals in case of a flat oil production?
Yeah, I think we could well see that this gas to oil ratio keeps going up, and that means that there will be continued growth in the natural gas liquids.
Yeah, and how do you see like rate develops into 25 and 26 then?
Sorry, which rate?
Your fleet-wide rate. Do you think it's
Yeah.
continue to be stable at current levels, or?
I think it looks good with growing demand overall, and we see a very stable supply picture. We don't have a lot of new builds at all in the handysize segment, and I think where we invest into the mid sizes, it's also mainly in the ethylene, ethane capable vessels, and here we also see a very good balance of demand and supply. So I'm quite confident.
Yeah, it should result in very strong earnings going forward as well for Navigator then. And a bit over to more sort of Navigator specific topics rather than the market in general. So you currently have a capital return policy of 25% of your earnings per share on a quarterly basis, with a minimum 5 cents per share dividends. You also undertaken additional buybacks beyond this capital return policy with 3.4 million shares during Q2 and Q3. And you also repurchased 3.5 million shares directly from the BW Group last year, with the net debt to EBITDA coming down steadily over recent years, making a fairly robust balance sheet if you're still confident in the earnings going forward. How do you think about the balance between paying out returns to shareholders against reinvesting in further growth? And do you see any potential for the capital return policy to be increased going forward?
Yeah. We ordered 6 vessels during the past year, and we bought 3 second-hands as well. So I think we have secured growth for the next couple of years for Navigator. We've been very consistent in returning cash, as you just mentioned here. I think we have capacity for more distributions. On August 11th, when we reported our Q2 earnings, we also reported that we had $340 million of cash and available liquidity at the time, which is very robust, and maybe even a little bit more cash on hand than we actually need. At the end of the day, this is a board decision. My personal view is that we have capacity for more distribution, but that decision sits squarely in the boardroom.
Yeah, I understand that. Do you have any goal for the leverage ratio in terms of the net debt to EBITDA?
No, we don't. I mean, we are running around 2.6, 2.7 times, and I think that's a good number. I think it's a conservative number. Had it been, let's say, between 3 and 4, I would also have been comfortable. So I think we have capacity for having maybe a little bit more debt on the balance sheet than we have today. So I think we have the capacity for it, but we don't have a target per se.
Yeah. And on the balance between dividends and buybacks, so we're calculating a net asset value of around $25 per share for your company. So buybacks obviously looks highly accretive to shareholders.
Yeah.
How do you think about it? Do you think the shares are still undervalued since you're continuing buying back shares?
I think if you have $25 per share as our net asset value, I think you must be putting a quite conservative number on our terminal. But leave that aside, we would probably come up somewhat higher than what you mentioned here. But as back to the question here, I think at this point in time, the right balance is that we return mainly through share buybacks. I mean, we've done it 3 times over the past 3 years, buying about 5% of outstanding shares each time. Until we eliminate the discount that we are trading at, I think that should continue, that we continue to, whenever the share price is weak, that we buy back more shares. I think there is space though overall for both paying higher dividends and share buybacks. But I think for now, when our stock is trading the way it is buybacks is the preferred measure.
Yeah, and given your view that the shares are trading fairly conservative at the moment, what do you think is the main reason behind this? And what kind of directly actions are you making in order to better reflect the underlying value of the business and also the growth potential in Navigator?
Yeah, it's very disappointing to see that we continue to trade at such a big discount. But I think if you look at the liquidity in our stock, if you look back in 2021, we were maybe trading about $1 million worth of stock on a given day. Today, that's getting closer to $6 million trading liquidity per day. So it's quite a significant increase in the trading liquidity, despite the fact that we've been buying back shares on the way. It's also meant that we have entered into the Russell 2000 and 3000, and I think that has also provided additional liquidity, additional trading. We have been very consistent in returning capital to shareholders over the past 3 years. I think that should help. You see a much stronger balance sheet today with the net debt to EBITDA that we just talked about. I mean, it was 7 back 5 years ago. Now it's 2.7, so a massive difference. Our returns have improved a lot when it comes to the industrial profitability of our business over the past 3 years. There's still a little bit of work to do before we get to double-digit return on equity, but we'll be working towards that. So I think with those things in place and the work that we are doing, we hope that we can eliminate that discount going forward. Randy is doing a fantastic job in explaining our business and our plans to the shareholder community, and I hope also that has an effect, and it already has had an effect clearly. So for us now, it's just laser focus on delivering shareholder value through both the returns that we're delivering, but also building a first-class Navigator that continues to generate strong and stable cash flows.
Yeah. I think that was my last question actually. Do you think it is any major topics we haven't discussed during the call, Mats?
I think you have covered many bases in this one, and I think we've moved around all the most important topics. So thanks a lot for a lot of great questions, and appreciate the conversation.
Yeah, thank you very much, Mats, for taking the time to share insight on Navigator and the market today. It was really a pleasure to speak with you. So thank you so much.
Thank you so much.